Today, we're diving into a concept that's kind of quietly reshaping the very foundations of finance and, well, ownership itself. Imagine a world where pretty much every asset, from a luxury apartment to maybe a share in a solar farm, becomes as fluid and tradable as a stock. But with much greater transparency and speed, we're talking about tokenization, really about harnessing technology to redefine ownership. This deep dive, it's going to offer you a shortcut, hopefully, to understanding this pretty profound transformation. We'll look at how it's breaking down old barriers and unlocking, frankly, unprecedented opportunities across loads of industries: real estate, fine art, private equity, even renewable energy.
Yeah, and it's important to stress this isn't just like an incremental upgrade of the systems we already have. It really is a fundamental rethinking of how assets are owned, managed, and traded. So whether you're maybe a seasoned institutional investor navigating complex capital markets, or perhaps you're a longtime blockchain enthusiast, like crypto OG, what's next? Tokenization is genuinely redefining what it means to own an asset in this digital age.
Okay, so let's unpack that a bit. The problem tokenization aims to solve. You mentioned these old systems. For decades, finance has relied on systems built for, an analog age, right? Can you give us a concrete example, like how clunky does traditional ownership actually get in practice?
Oh, absolutely. Think about buying property, just regular real estate. You often have to navigate this maze of intermediaries, brokers, title companies, lawyers. It involves weeks, sometimes months of paperwork.
Right.
And it's practically impossible to sell just a part of it. Partial ownership is pretty much an all or nothing deal. And what's really striking here is how traditional finance struggles with illiquidity. It means you can't easily sell. And high entry barriers, especially for private assets. So if you're a private company trying to raise capital, the whole process is just daunting, often limited by really high minimum investment amounts or strict accreditation requirements.
Yeah, I see.
And for investors on the other side, due diligence is incredibly complex, time-consuming. And finding a secondary market somewhere to sell these illiquid assets later, almost non-existent. If you step back, you can see billions, literally billions of dollars wasted every year just on fees and value erosion because of all these systemic inefficiencies. It's like a patchwork quilt thrown over a really outdated system.
That paints a very clear picture. So, okay, given these deep-seated issues, how does tokenization actually step in? What is it really at its core?
Well, at its core, tokenization is the process of creating a digital representation. Think of it as a token of a real-world asset, or maybe a right. And crucially, recording that token on a blockchain, it acts like a digital bridge connecting physical assets or financial assets to the digital world. And it ensures authenticity, security, traceability.
Okay, a digital bridge. I like that.
Yeah, and the really significant leap forward here is that these digital tokens, they can be bought, sold, or traded almost instantly, bypassing a lot of those traditional bottlenecks we just talked about.
That speed factor is compelling, definitely. But the natural follow-up question has to be, what kinds of assets are we actually talking about here? Is it just, abstract financial stuff, or can you tokenize actual physical things?
Oh, the scope it's surprisingly vast, actually. The report we looked at highlights a huge array. Everything from, say, fractional ownership of a luxury apartment in New York, right, to maybe a share in a solar energy farm down in South Africa. We're talking private equity funds, fine art like a piece by Picasso or even a classic Ferrari, gold, energy credits, corporate debt, even intellectual property.
Wow, okay. That's broader than I might have guessed.
It really is. And the key features that make this work are things like programmability. You use smart contracts, little bits of code to automate payments, like dividends or interest distributions. Then there's fractionalization. This is huge. It means you can divide really high-value assets, like that Picasso, into tiny tradable units. So you can maybe invest in it for as little as, say, $100.
$100 for a piece of a Picasso, that's game-changing access.
Exactly. And finally, there's global reach. Because it's digital and on a blockchain, it enables truly borderless transactions. You can attract investors from practically anywhere.
Okay, so this all sounds incredibly powerful. But a question I often hear, and I wonder about myself, is why now? Why is all this momentum building right at this moment? What's making tokenization take off?
Yeah, that's a great question. It really feels like a perfect convergence of several key factors. First, just the technology itself has matured significantly. Blockchain platforms, think Ethereum, Solana, Avalanche, they now offer the kind of scalability and, importantly, interoperability needed for real-world enterprise-level applications. They've kind of grown up from the early days.
So the tech is ready.
The tech is much more ready, yes. And maybe more broadly, we're also seeing really significant regulatory momentum. Now, historically, it's been pretty uncertain, right? But jurisdictions all over the world, you've got the EU with their MiCA framework, that's the markets and crypto assets regulation, a landmark piece of legislation.
Right, MiCA.
Yeah, and places like Singapore, the UK, the US, they're all actively developing clearer regulatory guidelines. And this encourages, critical thinking about how institutions, the big players, can confidently get involved.
Okay, so tech maturity, regulatory clarity starting to emerge. What else?
And finally, there's just rising investor demand. You see high net worth individuals, family offices, institutions, they're actively seeking alternative investments. They want access to asset classes that were previously really hard to reach. Plus, there are broader societal shifts towards digitization. Things like the pandemic definitely accelerated that, creating real demand for more efficient, more transparent digital systems across the board.
Makes sense. A confluence of factors. So let's get into the nuts and bolts then. How does this actually work? What are the core components involved in making tokenization happen?
Right, so it really leverages the power of digital assets and this thing called distributed ledger technology, or DLT. First, obviously, you have the tokens themselves, these digital representations. And they can be fungible, which just means they're interchangeable. Like $1 bill is the same as another, or one share of Apple stock is the same as another, represents a divisible part of something. Or they can be non-fungible, NFTs, which you probably heard about. These represent unique assets, like a specific piece of art or a particular collectible. One is not the same as another.
Fungible and non-fungible. Got it.
Second, you have smart contracts. These are basically self-executing agreements written in code. Think of them as automated processes. They can handle things like dividend payments, interest payouts, even compliance checks automatically based on predefined rules. Yeah, all built on the transparency and security of the underlying tech.
Okay, so the tokens represent the asset, the smart contracts handle the rules and automation. What holds it all together?
And that's the blockchain technology, or distributed ledger technology, DLT. That's the foundation. We're talking about that decentralized, transparent, and secure digital ledger that records all the token transactions and ownership.
Right, the ledger.
Exactly. And you can have different types. Public blockchains like Ethereum, which are open for anyone to use and view. Or you might have permissioned ones like Hyperledger, which are more private, often used by consortiums or specific companies where access is controlled. Okay.
And the process. If someone wants to tokenize, say, a building.
Generally, it involves about three main steps. First is deal structuring. That's all the upfront work, due diligence on the asset, assessing risks, figuring out the legal structure. Then comes issuance. That's the actual creation of the tokens and registering them on the chosen blockchain. And finally, distribution, getting the tokens out there. This happens through primary markets for the initial offering, and then secondary markets, often decentralized exchanges or specialized platforms for ongoing trading between investors.
Okay, deal structuring, issuance, distribution. That seems logical. Now, this all sounds impressive in theory, but where is this actually happening today? Can you give us some real-world examples, maybe for those institutional folks or the crypto OGs listening?
Yeah, definitely. The theory is meeting reality now. The report we looked at highlights some really compelling case studies. For instance, Hamilton Lane. They're a major global private markets investment firm. They actually tokenized a portion of a $50 million senior credit opportunities fund, and they did it on the Solana blockchain.
Okay, private credit. Interesting.
Yeah, and what was significant is it lowered the minimum investment required down to just $20,000. That enabled much broader fractional ownership and, crucially, boosted liquidity for what's normally a very illiquid asset class. That's a huge shift for private credit.
20,000 minimum instead of, millions probably?
Often, yes, exactly. And for the big institutional clients, look at BlackRock. They launched their USD Digital Liquid Yield Fund, BUIDL. It's a, I think, $500 million fund now with digital shares issued on a blockchain. That move doesn't just reduce their operational costs, it unequivocally signals massive institutional interest and validation in this space.
BlackRock getting involved is definitely a major signal.
Huge signal. We've also seen banks like Santander issue bonds directly on the blockchain. They did a $20 million bond, automating compliance checks and coupon payments using smart contracts. And then for maybe those more interested in democratizing access to unique assets, think about tokenized real estate. There was the St. Regis Aspen Resort project where people could buy fractional ownership, or even iconic art. Remember that Picasso, Filetto Beret, parts of it were tokenized, allowing people to invest for, again, potentially as little as $100.
It really does bring these high-value, previously inaccessible assets within reach for more people. That's pretty amazing.
It is.
And you mentioned it goes beyond just finance too, right?
Oh, yeah, absolutely. Think about supply chains. There's a company called Everledger using blockchain to track diamonds. This enhances transparency throughout the supply chain and helps significantly reduce fraud and conflict diamonds. Or on the environmental side, renewable energy credits. These could be tokenized. That makes trading them more transparent and efficient, which helps foster greener initiatives and funds sustainability projects globally.
So supply chain transparency, green initiatives, the applications seem really broad.
They really are. It's clear that tokenization is starting to redefine not just finance, but also areas like art, supply chains, potentially healthcare, even gaming. It's really powering new kinds of digital economies. And the projections. McKinsey and Company estimates that the total value of tokenized real-world assets could reach an impressive $30.1 trillion by 2034.
$30.1 trillion. That's an astronomical figure. But okay, let's be realistic. It surely can't be smooth sailing all the way there. What are the biggest hurdles? What could potentially derail reaching that kind of projection?
No, you're absolutely right to ask that. It's definitely not without challenges. The report clearly notes that regulatory ambiguity remains a pretty significant hurdle. While we're seeing progress, like with MiCA,
Right.
a lack of global harmonization, different rules in different places, can create complexity and uncertainty for big players. There are also practical technological integration issues. How do these new blockchain systems talk to the existing, often decades-old legacy systems that banks and institutions rely on? That's not trivial. And then there's the crucial need for market education and building trust. People, institutions, they need to understand how this works and feel confident using it.
Okay, so regulation, tech integration, and trust or education.
Exactly. Overcoming those hurdles will require continued regulatory clarity, hopefully more harmonization globally, and ongoing technological advancements to make adoption seamless and secure.
Well, we've certainly taken quite a deep dive today into how tokenization is, well, truly reshaping our world. From democratizing access to those previously illiquid assets, like we discussed, to streamlining complex financial processes. It feels pretty clear this isn't just, a small evolution. It really does seem like a revolution in how we define and manage ownership. So for you, the listener, here's maybe a final thought to mull over as we wrap up. If truly everything that defines ownership, that apartment, that share in a company, that piece of art, that carbon credit, if all that can be digitized, fractionalized, and traded instantly on a global ledger, how might that fundamentally change the way we invest, the way we consume, and maybe even how we perceive value itself in the decades to come? Something to think about.